In July, the Fed has decided not to hike interest rates. It appears that it is difficult for the Fed to take the decision to increase further its interest rates. Nevertheless, there is a current positive momentum on US economy and lower risk in foreign economies as the Brexit shock is progressively absorbed. But by essence, financial markets in this particular environment are unstable and large swings in volatility could be expected further. The Fed does not want to take markets by surprise, and only a moderate tightening bias or willingness to tighten is present in its communication with no precise timing. July FOMC statement has left the door open for a potential adjustment in September or in December. But the balance of risks in September should not be really different from its current level. A hike in December is another option, ranked at a higher probability by money markets and in our own scenario. At this time, we can hope that parts of European problems and banks and politics would have been partly resolved, and we will have a more clear view on economic trend in the different regions. The main uncertainties for the Fed should come from the inflation and wage growth trend at year-end, a reason to hike, but also from the political situation just ahead of the new mandate of the new elected president. During this time, other central banks will continue to ease. We expect shortly new support coming from the BOJ and the Bank of England through a mix of small decrease in interest rates and specific liquidity measures to boost credit. The ECB could also extend the maturity of its QE in September or more probably in December too. It is obvious that Fed and other central banks have adopted diverging strategy. But Fed focuses more on global risk management rather than a decision rule based strictly on domestic trend. Other central banks in developed and emerging countries should remain on an aggressive easing stance during this period of time. Is it a new monetary policy conundrum? We enter a new episode of this new monetary regime we experimented after the financial crisis. This episode is not only defined by a relatively dovish Fed, a zero or negative interest rate policy, but also by the larger role played by non-conventional monetary tools on economies and markets.